Hey everyone, welcome back to Corporate Decoder. Today, GEF Incorporated just filed an 8K, and I'm seeing some interesting financial tidbits that shed light on their recent performance. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing gives us a peek into Greif's financial health, especially by looking at their reported numbers and the adjustments they make, which can tell us a lot about the underlying business. So, Greif Incorporated, or GEF as many know them, operates in the packaging and containers industry. They are a pretty established player with a significant market presence. Today's filing, an 8K, is a way for companies to report significant events that shareholders should know about. This particular filing focuses on their second quarter results ending the 31st of March. 2026, and it was announced on the 28th of April, a couple of days before this report. The main event here is the announcement of their financial results. Now, companies often use what are called non-GAAP financial measures. Think of these as adjusted numbers that management believes give a clearer picture of the company's ongoing operations. They exclude certain one-time or unusual items. While useful for comparison, it is always crucial to remember these aren't the official generally accepted accounting principles numbers. Greif explicitly states that while they and investors find these adjusted figures helpful for comparing performance over time, they should never be seen as a replacement for the actual reported results. It is like looking at your bank statement versus your budget plan. Both are important, but they tell slightly different stories. Digging into the details, Greif is highlighting things like adjusted net income, adjusted earnings per share, and adjusted EBITDA. These metrics essentially try to strip out the noise of specific expenses or gains that might not reflect the core business's steady performance. Management uses these to gauge how well the day-to-day business is running and believes it is valuable for investors to see these figures to understand the trends. They want people to be able to compare this quarter to previous ones without those temporary bumps or dips in the numbers. So why do companies do this? Well, imagine a company had a massive one-time expense to restructure a factory, or maybe they sold off a piece of land for a big profit. Those events can make one quarter look unusually bad or unusually good. By excluding them, the company tries to show you the underlying strength or weakness of their main business activities, things like making and selling packaging. It helps maintain a more stable picture of performance year over year, which is what many investors look for when making long-term decisions. But it is a delicate balance. It is essential to understand what these adjustments are. Are they truly one-off events, or are they things that keep happening? If a company consistently excludes similar types of costs, it can sometimes be a way to present a rosier picture than reality. This is why the Securities and Exchange Commission, or SEC, requires clear explanations of these non-GAAP measures and emphasizes that they should not be considered better than the official GAAP numbers. Adding to the picture, Greif also held a conference call the day after their earnings release. This call is where executives discuss the numbers and answer questions from investors and analysts. It is another place where you can often get more color on the financial performance, strategic direction, and future outlook. The transcript of this call is also included in this filing. This particular filing is important not because it contains entirely new earth-shattering information, but because it bundles up the official announcements and supporting documents for Greif's Q2 2026 financial results. It is the company's way of making sure all the material information about their performance is properly filed with the SEC and accessible to the public in a structured format. You can find the press release and the conference call transcript attached as exhibits, which are essentially the detailed supporting evidence for the report. And finally, the report is signed off by Lawrence A. Hilsheimer, who is the Executive Vice President and Chief Financial Officer. This signifies that the company's highest financial authority has reviewed and approved the content of this filing. Looking at Greif's broader context, they are in a cyclical industry. When the economy is strong, demand for packaging often goes up as businesses produce and ship more goods. Conversely, when the economy slows, so does demand for their products. Their market cap is in the billions, and they have a substantial number of employees, suggesting a large and established operation. Recent news has shown some share price sensitivity, with a notable gap down reported in late April of 2026, which this earnings report likely addresses. The fact that they declared a dividend in late 2025 also shows a commitment to returning value to shareholders, a positive sign for stability. Now, the real story in these filings often comes down to the numbers and how they stack up. While this specific 8K is more about presenting the earnings release and conference call, it points to the details within those documents. We would want to see the actual revenue figures, net income, and importantly, the reconciliation between GAAP and non-GAAP measures, for instance. If adjusted earnings per S-hair are significantly higher than reported earnings per S-hair, we'd want to understand the specific adjustments. Are they about cost savings that are likely to stick around, or are they about accounting maneuvers? The news about a gap down in their stock price around the earnings announcement suggests that investors might have found something in those details, whether it was lower than expected growth, rising costs, or a less optimistic outlook for the next quarter. Given the information provided, it is clear Greif is focused on providing investors with tools to track their performance continuously. The emphasis on adjusted figures suggests management believes the core business is performing well, but the market's reaction, as hinted by the gap down, indicates that either the actual results or the forward looking statements within the earnings release may have fallen short of expectations. The key for any investor is to dissect those non-GAAP figures, understand what is being excluded, and see if those exclusions align with a sustainable business model or if they mask underlying issues. That is my take. Stay decoded. If you found this breakdown helpful, remember to like, subscribe, and join our Discord community, all linked in the description.